Welcome to everyone. We are continuing our chapter accounting for receivables. Today we will describe how companies value notes receivable, record their disposition and present and analyze receivables. We are treating it as part 4 and chapter name accounting for receivables, and everybody knows that's our book name. Just accounting principle, writer Weigand, Kimmel and Kieso. Okay, this is chapter 9, accounting for receivables. This is the chapter, and today we will discuss learning objective 4. Describe how companies value note receivable, record their disposition and present and analyze receivables. Okay, move to next. First one, valuing note receivable. Here valuing note receivables, this one, report short-term notes receivable at their cash or net realizable value, number one. Number second, estimation of cash realizable value and bad debt expense are done similarly to account receivable. And number third, allowance for doubtful accounts is used. And valuing note receivable, just we need to be followed these three matters. Disposing of note receivables, notes may be held to their maturity date, number one. Number second, maker may default and payee must make an adjustment to the accounts. Previously we have discussed more maker or holder of the notes, and holder speeds up conversion to cash by selling the note receivable. These three matter for disposing of note receivable. Now disposing of note receivable, here we will discuss on 2 points: owner of note receivable and disowner of note receivables. In owner, maker pays, maker, those who make or manufacture or prepare the note, he will pay in full at their maturity date, number one. Number second, disowner, not paid in full at maturity and no longer negotiable. These 2 points here, and owner 1 point here. That means the maker must pay in full at their maturity date, and in disowner not paid and no longer negotiable. Okay, I think everybody is clear. Move to next. Owner of note receivable. Please look this illustration, everybody. Older company lends Higley company $10,000 on June 1, accepting a 5 months, this is important, 9% interest note. And if older presents note to Higley company on November 1, the maturity date, older's entry to record the collection is, that means older will receive the money from Higley company. Okay, that means older lends, company lends Higley company. So here older presents the note to Higley on November 1. Please now pay to me. That means to older company, and that time, time is November 1. And here the journal entry will be cash debit and noticeable credit and interest revenue credit. And how could we calculate the interest? This is amount, this is rate of interest, and this is the time period, 5 months. So 5 months divided by 12, and the 12 months make a year. So 5 divided by 12, and after calculating we will get $375. Okay, so here note receivable must be credit and interest revenue credit, and this is the owner $10,375. Okay, I think everybody is clear. Now accrual of interest receivable. This is very interesting matter. Suppose instead that older company prepares, that means older company prepares financial statements as of September 30. instead of November. So adjusting NT by older is for 4 months ending September 30. So here this is the 4 month June 1 to September 30. June, July, August and September. These 4 months earned $300, and 1 month this is November earned $75. So total receipt will be $375, which we have shown earlier. So here the question is simple. Uh, Prepare financial statement September 30. So up to September 30, the earned $300. I think everybody is clear. So interest receivable debit or interest revenue credit. So this is the calculation. I think everybody is clear here. Moving next, accrual of interest receivable illustration. Prepare the entry holder would make to record the honoring the Higley note on November 1. So here cash debit and note receivable credit, interest receivable credit, and interest revenue credit. Okay, I think everybody is clear. Then dishonor of note receivable. Dishonor. Now dishonor of note receivable. Please uh, notice everybody. Assume that Higley Company November 1 indicates that it cannot pay at present time. They are unable to present. That means Higley Company not able to present. If older company does accept eventual collection, it would make the following entry at the time the note is dishonored. So assuming no previous accrual of interest. So here the journal entry will be account receivable must be debit here, and note receivable interest revenue credit, and note receivable credit, and account receivable will be debit, this figure. Okay. Then statement presentation and analysis presentation. This is balance sheet, this is income statement. So identify the balance sheet or the notes each major types of receivable. Number 1, report short-term receivable as current asset. We know everybody this matter. Everybody knows this matter, I think. Report both gross amount of receivables and allowance for doubtful accounts. And income statement, report bad debt expenses and service charge expenses as selling expenses. Report interest revenue under other revenues and gains. Very clear. I think everybody is clear by getting this point. That means the presentation in the balance sheet, presentation in the income statement. Okay. Moving next, analysis. This analysis is very simple, I think. Illustration: in 2013, Cisco system had net sales this amount figure. Uh, this is million dollar, and it had a beginning accounts receivable net balance, this 1 million, this figure, and the end account receivable net balance, this figure in million. Assume that Cisco sales were all on credit. If its account receivable turnover is computed as follows. Please look here. Net credit sales, this figure, that means this one, and average net account receivable, this figure, and this figure, these two figures, that's here, and this is average divided by 2, and we are getting, after calculating account receivable turnover, 7.7 times throughout the year. So here analysis another one, this 7.7 times, if we calculate in terms of days, that times days in the year 365 days, after dividing this times, we are getting 47 days. This is the average collection period in days. Okay, I think everybody is clear. Now do it. Analysis of receivables. Very simple matter. In 2017, Philip Michelson company had net credit sales, this one. That means this is the net credit sales. and this is the beginning balance and this is the ending balance. Okay, very shortcut. Just here 2 points. Number one, account receivable turnover, and number second, average collection period. So after using these two balances, that means beginning and ending, this figure we are getting accounts receivable turnover, this one, and just we are we will show this figure here, and we will get the average time, collection time, that means the average collection period in days, 14.7 days. I think everybody is clear this analysis of receivables. So thank you so much for joining with us.